As I told you, we are in a new topic. What is a new topic? Like your cost of capital. You have collected money from the public in the form of debenture. Debenture means, remember, this is loan. Unless and until you close your company, you will not pay only. So that is called non-repayable, or else even though he is the owner of the company, he has to pay dividend. Now, right hand side of the balance sheet means it is nothing but your liability side. Hello everyone. So now we are in the new topic called your cost of capital. So these your others lecturing Vidhyaashram First Grade College, the Temple of Excellence. As I told you, we are in the new topic. What is a new topic? Like your cost of capital. Now, so we're done with your first chapter, that is all your introduction, basic theory part. Your second chapter is your time value of money. And the third topic, it is your cost of capital. Now, under cost of capital, what we are going to learn. Now, in your examination, almost your marks will be covered with this topic only. Why? Because for your 5 marks, you have a question. 10 mark, you have a question. 15 mark, still you have a question from this topic. All 5, 10 and 15 marks, all problems only. So, almost it will cover 15 plus 10 plus 5. Almost it will cover 30 marks out of your 80 marks paper. One of the most important for your examination. Just this chapter will give you passing mark. What is your passing marks? Out of 80, you are supposed to get minimum 24. That 24 you can get only from one topic, that is called your cost of capital. Now, in today's session, we will understand only the basic concept. We will not do any problems. The problems will be done from the next session. Now, so in this, we will understand about meaning, concept as well as WACC. What is WACC? Weighted average cost of capital. I'll explain you what is weighted average cost of capital in the coming slides. The first part we call it as meaning. So meaning under this, the cost of capital is the minimum rate of return in this. So before that, we'll understand what is cost of capital. I'll read out this. Later, I'll give you a simple example for what is cost of capital. Now, the cost of capital is the minimum rate of return required on the investment projects to keep the market value per share unchanged. I'll give you simple example. Now, you are running a finance office or a bank, a small cooperative bank you are running. Now, so you are giving in this cooperative society or something, you are collecting money and you are giving money. Like you will take it as a deposit as well as you will give it as a loan. Now, for example, you collect 50 lakh as deposit. How much you will collect? You will collect 50 lakh as deposit from the public. How much percentage you will give? You will give almost 8% to the public. If somebody come and deposit their money in your bank, how much you are giving? Per annum, you are providing 8% interest. Now, so 8% interest you are giving from your hand. Now, whatever 50 lakh you collected from public, this can be given as loan to outsiders. I'll collect 50, I'll give 50 lakh. So, whatever percentage I'm giving 8%, how much percentage I'll collect from public? It must be more than 8. It can be 12%. It can be 12%. I collected 50 lakhs from somebody. I'm given 50 lakh to somebody. I'll collect 12%. Out of 12, 8% I'll give it to this fellow. The balance 4% is my profit. Clear? Any doubt? So, I am collecting 12% from the person called, he has taken loan, and I am giving 8% to the person who has deposited. The remaining 4% in between, by taking all the risk, I am earning 4% as a income. Or else I can give loan 15% also, 7% is my profit. I can give this for 20% also loan, 12% is my profit. Now, is there any chances you are giving deposit 12% and for loan you are collecting 7%? No. Why? Because your income is 7%, your expenditure is 12%. Will you do this kind of business? No. Always we expect your income must be more than your expenditure. Remember, your income must be more compared to your expenditure. These are called as your cost of capital. This will indicate you, this will inform you what is your total cost, so that you will be alert that your income must be more than your cost. Now, you are started a new business for 50 lakh. What is the new business cost? 50 lakh. You collected 10 lakh from somebody, 10 lakh for somebody, 20 lakh as well as another 10 lakh. Total your investment is 50 lakh. All put together, you are paying interest how much? 1,50,000 you are paying interest. Your income must be more than 1,50,000 or less than 1,50,000. It must be more than 1,50,000. If it is less than 1,50,000, no use of doing that business. I'll give you one more example. I am running stationery shop. I bought this calculator for 100 rupees. At what price I have purchased? 100. To customer, I have to sell it for more than 100 or less than 100. Normally, it must be more than 100. If I am selling this for 120, this 20 is my profit. If I buy this calci for 100 and I am selling this for 80 means, is it possible? Yes, it is possible, but you cannot run your business for longer period. Why? Because every calculator you are losing 20 rupees. Why you purchase for 100 and give it for 80? Instead of that, without doing business, you can be at home only. Now, always we expect the return must be higher than your expenditure. So, this kind of calculation we call it as cost of capital. What is capital? Your investment into the business, 50 lakh, that is your capital. What is cost? You are paying 1,50,000 interest every month or per annum. So this is your cost of capital. This all talks about cost of capital. Now, in other words, the cost of capital is simply the rate of return the funds used should produce to justify their use within the firm in the light of the wealth maximization object. With this cost of capital, your wealth maximization can be done. Next, cost of debt. So in the cost of capital, you have four major topics. Which are those? The first thing will be cost of debt, and the second one cost of equity, third one cost of preferences, and retained earning. I'll explain you one by one. Under cost of capital topic, you will work out these four: cost of debt, cost of equity, cost of preferences, and the end one, cost of retained earning. Retained earning, normally it is a free of cost. I'll explain you what is retained earning in the later stage. Now, cost of debt. Debt means what? You have collected money from the public in the form of debenture. Debenture means, remember, this is loan. You have to pay them interest. This is called as debenture. Now, as per this, it is relatively easy to calculate cost of debt. It is very easy. Why? Because if you are taken 10 lakh as a loan debt, 10%, how much it is? 1 lakh. Easy calculation. If you are taken 20 lakh as debenture, what is the percentage? 10%. How much it is? 2 lakh. Easy. So, whatever debenture you have collected, whatever money you have collected from public in the form of debenture, you are supposed to pay interest fixed. Now, these are called as, it is relatively easy to calculate cost of debt It is rate of return or rate of interest. Now, rate of interest means how much you are paying. Now, specified at the time of debt issue. So, no need of any confusions in this. Why? Because at the time of issue itself, you know what is a percentage, you know what is a value, you know how much you have to pay every month, every per annum. Everything will be predefined in this concept, like cost of debenture. When a bond or debenture is issued at full face value and to be redeemed after some period, then the before tax cost of debt simply. So I'll explain you this. What is this? Now, under debenture, we'll have two things. One is redeemable. Another one is irredeemable. Redeemable, irredeemable. Redeemable means what? Redeemable means, remember, it is repayable. Redeemable means repayable. You have taken 10 lakh from the public. After 5 years, you pay it back. That is called redeemable, repayable. You have taken 10 lakh from the public. Unless and until you close your company, you will not pay only. So that is called non-repayable or else irredeemable debenture. We have different formulas for redeemable as well as irredeemable. The formulas and all will work out and we will learn at the time of problems. If I tell you now, you will not remember that. While doing problems, I'll explain you what are the formulas and what are the formulas you are supposed to remember. Now, I hope you understood. In debenture, we have two things: redeemable, irredeemable. Different formula for redeemable, different formula for irredeemable. Now, these are the easiest topic. Hardly you will get 5 to 6 formulas. If you remember 5 to 6 formulas, what will be your marks? 30 marks. Remember that. Now, redeemable, irredeemable. Redeemable stands for repayable. Irredeemable stands for non-repayable. Now, the next part will be cost of preference shares. So, what is preference shares? As you know that there are shareholders are there, two types of shareholders. One will be equity shareholders, another one will be preference shareholders. Now, if you have taken money from the public in the form of preference shares, then what you are supposed to do? Here there is no interest, but you are supposed to pay dividend. Dividend you are supposed to pay. This dividend we call it as cost of preference shares. If you are taken money from preference shareholders means every year you are supposed to pay them dividend. Your income must be more than these dividend whatever you are paying. Now, I'll go for the definition. The measurement of the cost of preference capital poses some conceptual difficulties. In the case of debt, there is a binding legal obligation on the firm to pay interest, and the interest constitutes the basis to calculate the cost of debt. This is all about your debenture. In the debenture, there was a fixed rate of interest supposed to be paid. But, however, when reference to the preference share capital, it may be stated that the payment of dividend on preference shares is not legally binding. It is not legally binding means in debenture what happens? Every year they are supposed to pay interest to the debenture holders. Now, company is under loss, then what happens? Still they have to pay interest. Company is under huge profit, still they have to give whatever the percentage they have mentioned, that much only they are supposed to give. But in case of preference shares, if there is a profit, then dividend. If there is no profit, no dividend. Remember this. Company earns profit, pay dividend. Company is not earning profit, don't pay dividend. These are the logics we are supposed to remember. Now, and even if the dividend are paid, it is not a charge on earnings. Rather, it is a distribution or appropriation of earnings to a class of owners. Hope you understood. This is all about your preference shares. No need to remember all these definition points and all. You will not get any question for theory for these things. Okay. The theory questions I'll give you at the end. which are the theory questions you are supposed to remember. Now only you have to concentrate on problems. Theory at the end I'll give you which are the questions supposed to become for 5 marks. Hardly there are 7 to 8 questions are there. If you prepare that, that is sufficient. Now here only I have given theory to understand the concept, not to remember these things. Cost of equity shares. Once we done with your preference shares, the next part we call it as equity shares. The equity shares are also called as the real owners of the company. Why? Because all the risk and burden will be taken by equity shareholder. If there is no profit, equity shareholders has to bear the losses. If there is losses, they have to bear. If there is a profit, then only they can collect after giving to the debenture holders, after giving to preference shareholders. If anything is left, then only equity shareholders will get their income. And there is no redeemable, irredeemable concept in equity. It is always irredeemable, non-repayable. Now, it is sometimes argued that the time equity capital is a free of cost. Normally everybody says that cost of equity is always free. It is not. Even though he is the owner of the company, he has to pay dividend. Now, this is not true. The reason for advancing such an argument is that it is not legally binding. Not legally binding means it is not that compulsory you have to give. If there is profit, you give it off. If it is no profit, don't give. Now, company to pay dividend to the common shareholders. Also, unlike the interest rate on debt or the rate of dividend on preference capital, the dividend rate to the common shareholders is not fixed. Normally, preference shareholders, there is a fixed rate of dividend. But for equity shareholders, there is no fixed rate of dividend. Nothing much. I don't go in depth. Why? Because theory it is always boring. That's why, and as well as these things will not come for exams also. Just you need to remember we have cost of equity share also. Again, I'll go back. I wanted to tell something in this. Cost of debenture, we call it as KD. Cost of debenture. You may ask, sir, cost is C. Why you have taken K? Why? Because normally it started from Britishers. So Britishers, if you go to system and if you type the capital C, they will not use, they will use capital as K. That's why here also we are using capital or cost. It comes with K only. Cost of debenture, KD. Cost of preference shares, KP. Next, cost of equity shares, KE. Next one, retained earning. We are not supposed to pay anything for retained earning. Why? Because it is your own savings. What is your savings? For example, in 2018, 2019 and 2020, your savings is around, or your profit is 1 lakh. Again, your profit is 2 lakh. Your profit is 3 lakh. These are your profits. What will be your savings? Now, out of 2 lakh, if you calculate 10%, 20,000 is your profit. Again, 10% if you save, so it is 10,000. So it is 20,000. And this will be 30,000. So total how much? Total it is 60,000. What is your savings now? Your total savings we call it as 60,000. Your total savings is how much? 60,000. Now, whatever you have saved every year, 10,000, 5,000, 6,000, all the savings we call it as retained earning. This is what I told you, profit. Profit also called as what? Earning. Earning means profit. Retained means you have saved with yourself. Whatever profit you have retained is called as retained profit or retained earning. Now, so in this, we don't have any charges. We need not to pay any dividend. We are not supposed to pay any interest. There is no obligation for this thing. This we can call it as free of cost. But Still we charge. How we can charge? How we can charge means whatever answer you got for equity share, the same answer you'll consider for retained earning. Even though it is a free of cost, if equity shares you got 10% cost, the same 10% cost will take it for retained earning also. Now, the company are not required to pay any dividend on retained earning. Therefore, it is sometimes observed that this source of finance is cost free. But retained earning is a dividend foregone by the shareholder. And one more thing, what happened? Why we calculate your equity share to retained earning even though it is a free of cost? Why? Because see, whatever savings 60,000 you have made, if you invest the 60,000 into the business, you are losing your interest part. The same 60,000 if you deposit in bank, you will get interest. That interest you will be foregone. That's why we have to calculate cost for even retained earning also. Hope you understood. This is called retained earning. The last part, I don't go much about this. Why? Because while doing problem, I'll explain you. Then you will understand better. I'll give you a brief introduction about this. What is WACC? WACC stands for your weighted average cost of capital. So far we have discussed. So this we call it as KO. KO means overall. Now, so far we discussed about cost of equity, cost of preferences, cost of debenture, retained earning. All put together, we call it as KO. KO means WACC. All total of all the cost, we call it as WACC. So your 15 marks problem will be based on WACC only. Whatever we have discussed, cost of equity, cost of preference, cost of debenture, retained earning, all will come for 10 mark or 5 mark. But this WACC comes for complete 15 mark problem. Now, as per this, company weighted average cost of capital is how much it pays for the money it uses to operate, stated as an average. It is also the minimum average rate of return must earn. Means, if you do WACC, you will get to know, like example, you want 50 lakh as capital investment. How much you needed? 50 lakh. From equity shareholders, you have taken 10. Preference shareholders, 10. Debenture holders, 20. Retained earning, some 10. How much you invested? 50 lakh. Now, equity shareholders, you are paying them 10% dividend. It is around 8%, 12%. Some equity shareholders, how much? 10%. These are the cost you are incurring. Whatever amount you have collected for investment purpose, these are the expenditures you are making. Your income must be what? More than this or should be less than this? It should be more than this. Now, you have 1 is 10, 8, 12, 10. What is the average now? How do we find out average? We don't go individually. I want total. For 50 lakh I have taken. How much I have to pay them? So, overall cost is what? For that, we should calculate WACC. Hope you understood. If you want cost of equity, go for this. Preference, go for this. Debenture, go for this. But I want all put together, how much? Then you should go for WACC. Under WACC, it says that what is your total cost. Clear? Yes, this is all called as your WACC. The WACC is based on business firms' capital structure. The capital structure of business firms is essentially the right hand side of its balance sheet. Right hand side of the balance sheet means it is nothing but your liability side. First thing is what? Your capital. The capital, it is nothing but your investment. Now, this is all about your WACC. I don't go much detail because you will not get any theory questions on this. Now, just for the remembering this, advantages as well as disadvantages. What is the advantages of WACC? The business will know the difference between project funded by the debt, in terms of capital to the project funded by equity. How much you have taken by equity shareholder, how much you have taken from debenture holders. That will be understood with the help of WACC. WACC takes into account the normalizing the cash flow for present value. This is also major advantage. Third one, WACC is simple and allows management to look quickly for the project. For the project, how much you have spending, what is the cost of this project, easily will get to know with the help of WACC. These are the major advantages. The limitations are WACC number isn't very useful if they don't understand the return on this capital. If they give wrong information, if your calculation is wrong, your returns also will become fluctuating. Second one, the equity side of the capital cost is done by the identifying the risk of the project compared to future project it may be invested in. You cannot do comparison for the current year as well as next year. Last one, unforeseen problems may come up that require capital that wasn't in the projected forecast. When capital increases, so does the risk from investors. The overall cost of capital may increase during the project. In the beginning, your plan was 50 lakh, you have done your WACC for 50 lakh. As soon as projects is going on, the cost increase, 50 has become 70 lakh, but your WACC is prepared for what? 50 lakh, so that it will not give a true or fair view for your return investment. So these and all the disadvantages are limitation just for the concept as well as for better to know all the advantages and disadvantages, but in your examination these things will not help you. Just be aware of these things, but exam only concentrate on problems. If you want, you can take screenshot, but again I am repeating you, the theory part is not required for your examination. I'll give you which are the theory part important for your examination at the end of my sessions. So this is the meaning of cost of capital, cost of debt, cost of preference shares, cost of equity shares, your retained earning, your WACC, advantages of WACC, limitations or disadvantages of WACC. So this is all about your today's session. Hope you understood what our WACC stands about. So in the next session, we'll go with the problems. It will be very interesting, as well as if you go for MBA or MCOM, the same concept you have for your post-graduation also. Thank you.